Hello and good afternoon, everyone, and welcome to Bull Prime's webinar. I'm Alex, your host today, and we have a guest speaker to share secret techniques on reading and predicting the market movements through the chart patterns. Whether you're new or a seasoned trader, we hope you find today's session informative and insightful. And just a note before we begin, the sharing session will last for approximately 45 minutes. And after the sharing, we will make time for Q&A. So feel free to ask questions throughout the session on the Q&A part at the bottom of your screen. So without further ado, just let me introduce our speaker for today. He's no stranger to us. He was featured on Singapore's Channel News Asia for gaining $30,000 in 2 years. He has won awards such as the most popular FX trainer in Asia Pacific and top Forex analyst by WeeklyFX. His goal is to help others achieve financial mastery by empowering people to design the life that they want. So I present to you Kar Yong. Over to you.
All right, good afternoon, everyone. So welcome to today's session over here. Great to have this opportunity to share with you my experience and, of course, what I've learned from the market. Hopefully, it's going to be a valuable session as well as something that you can take away from today. We do have Q&A as well. So as we progress throughout this session, if you have any questions, feel free to just drop your questions in the Q&A tab. We'll have those questions answered at the end of the session. Okay. So very quickly, let's jump straight into the session today with the topic on reading candlesticks and chart patterns. We'll be first looking at the slides that are prepared for you guys, after which we'll jump into the charts, okay, in a live market environment, to show you some of the direct application of what we have covered so far. Okay. Just a quick check. I think Kanan over here mentioned that there's no sound. I think it should be working fine. So maybe you want to check if your side is actually muted. Yeah. Okay. So let's start straight up by understanding first what is candlestick. Okay. This is especially important for traders who are still fairly new in the market. Okay. Candlestick is actually one of the essential foundations that many traders actually need to know to understand what price action is. Okay. And typically, it's in black and white, but of course, really depends on your personal preference on color settings and things like that. But for today purposes, whatever you see on the slide over here, okay, it's gonna be based on white and black candles. Okay. Now, what are candlesticks, right? Candlestick is actually developed in Japan, but it's actually popularized by this trader called Steve Nelson. Okay. He kind of like started to make this whole concept of reading candlestick very popular. Okay. And from there on, I would say almost every trader that comes into the market looking at technical analysis would need to understand what candlesticks are. Okay. Now, we walk through some of the basic elements of a candlestick first. Okay, so over here, you can see some of the, let me just pull out my annotation. Okay. Right, okay. So there are some elements that you need to be very familiar with when you're looking at a candlestick. Okay, the first thing here is we have the high, low, open, and close. Okay, now what exactly that means is that every time we look at a candle, that is what we call an open price. Okay, so on the left, you can see this is what we meant by open price. It means that the market price started at that particular period at that particular price. Right? And during that period of time, depending on the time frame, it can be a 1-minute candle, a 5-minute candle, or an hourly or a daily candle. So depending on the time frame, obviously that means that if today we're in a 1-minute candle, this candle represents 1 minute of data point. So the open is the start of that particular time window. And as the price continue to move, right, it can go up, it can come down, it can go down, it can then come back up. But basically during that window of period, let's say within a minute time frame, the price prints a low and it prints a high. Okay, that means during the particular minute, the price went as low as this price point and went as high as that price point, and eventually within that 1 minute settled down at a closing price. Okay, so I just want you to visualize, okay, how this happen is the market opens here, it went down, it went back up, and then just before that minute conclude, it actually comes back down and it closes here. All right, and from there it forms that candlestick. Okay, so there are 4 elements you first need to understand: open, close, high, and low. All right, and from there, that's where we form what we call a body, okay, which constitute the open and the closing of that particular candle. And then we have the shadow, the upper shadow, and the lower shadow. Right, so that's the foundation, the basic understanding of a candlestick. Right? Now, if the market actually opens and closes at a lower price than where it opens, then usually we'll denote that as a black candlestick, right? Or of course, some traders would put it in red, okay? Because the market is coming down, they put it in red. Okay, so if it's a up candle, which means the market opened at a lower price and closed at a higher price, usually it's white or in green, okay? Again, it's a personal preference of color choice, but those are the default setting, right? So when you see white candle body, oftentimes it means that the market price is going up. If you see a black candle body or a red candle body, it means that the market is coming down. Okay, so I hope up to this point, pretty straightforward, you guys are able to follow through what exactly is a candlestick. Okay, so some understanding of candlesticks, as I mentioned, okay, we have the body, we have the upper shadow and the lower shadow. Now, of course, it comes in various sizes and slightly various shapes, but the autonomy over here is today, if you look at a candle and we have long bodies, okay, which means that if today the market opened at this price, it went up, and it closes at a very high point, we have a huge candle body, it indicates strong buying or selling, depending on whether is it a white candle or a black candle. Right? A short body denote that there is little activity, there's little movement in the market. Okay, so when you see a big candle, which basically a long body, means that market momentum is there. There's a lot of activities where traders are pushing prices, whether is it up or down. If you see a very small candle, okay, that means that the activity during the particular window of period is very, very small. Okay, there's not a lot of traders participating in the market, and the prices didn't really move a lot. Okay, so this is where you also want to understand the term volatility. Right, if today there's a lot of activities happening in the market, prices are moving quite significantly, we use the term volatility to describe it. Okay, we say that it's highly volatile, which means prices are moving along. If today there's not much activity in the market, we say that that's low volatility, right? There's not a lot of movement in prices, right? So that's what we meant by candle body, right? So that gives you a little bit of an information and clue as to what prices are doing during the particular window. Now, next thing here is sometimes you'll observe that certain candles would give you long shadow. Okay, so things like this over here, right? You can see there's a very huge shadow and a very small body. Okay, often this suggests a potential reversal is coming, right? So of course, we will show you in a live chart later on how is it being applied in terms of your trading. Not every candle that has long shadow equals to a potential reversal. Okay, you need to add layers of analysis to it. But from an individual candle point of view, when you see a long candle, or sorry, a long shadow, what it essentially means is that the price initially opens here, it went up, and then it came all the way back down, and it decides to close somewhere at the low point, right? So think of it as like today in an analogy, right? You want to go in a particular destination, right? And then you realize that halfway through your journey, it's the wrong direction, it's the opposite direction. What will you do? You do a U-turn and then eventually head back to where you want to go, right? So think of it as price initially wants to go up, but then there's a lot of sellers coming in and it decides to push price down, right? So it starts to form some kind of a V or a U-turn. And oftentimes within that window of period, you would create this sort of a candlestick formation, right? So that's where the idea of a potential reversal comes in, okay? Which means initially price wanted to go higher, but it faces a lot of sellers, a lot of resistance, and then it just U-turned, it came back down, and then it forms that huge shadow, okay? So that's the basic gist of an candlestick. Okay, you have your body. Huge body means a lot of volatility, a lot of activities that's happening during a period of time. Small body means there's a little bit of activity, not huge. Long candles with long wicks, right, or what we call shadows, they basically means that it's a potential reversal. Okay, so those are the basic understanding of a candlestick, right? And as I mentioned, it comes in various shapes and forms. We'll explore some of them throughout today's session. Right? So those are the two things to start off with. Okay. Now, once you understand the basic gist of what a candlestick is and how it's being formed, there are many different variations to it. Personally, I would share with you, you do not need to memorize all of it. You do not need to know all of it. Always fall back to the basic foundation of a candlestick, which is developed by the 4 data points: open, close, high, and low. Right. So today when you see a candle, for example, right, this one we call a spinning top, right? What you're observing here is the body is not huge, it's somewhere in the middle, and then you have some upper shadow and then some lower shadow. Okay. So what this means is that you can actually, tell a story behind the formation of the candle, right? Because it's a white candle, it means that it opens at the lower price, it closes here. And there's a high and a low, which means during this particular window period, what happened for price is that it opens here, it can go up, it can come down, it can went back up, it can come back down, but eventually during that window period, it settles here. Okay, so this means that price actually tried going up, it tried coming down, and then at the end of this period, it actually settled where it initially started, around that area. So this tells you a story. What happened during this period is that the price tries to go up, the price tries to go down, but at the end of the day, it didn't really go anywhere, right? At the end of the day, it just came back to where it started, right? So it kind of tell you the information where there are people pushing prices higher, there are people pushing prices lower, then there are also buyers supporting lower prices, and then eventually just started where it came back where it started. Okay, so this means that both the buyers and the sellers couldn't really decide on a price point, and there are people buying, there are people selling, but eventually both are indecisive, right? And that's where this pattern comes in. Okay, so instead of like memorizing the name of the candle, I want you to really understand the story behind how the candle formed, and that actually gives you a much better understanding in terms of like what exactly it means. Okay, so when you see something like that, right, same thing here in a black candle, it means that the price actually opened at a high price and then it closes here, but the whole story is the same. It has people buying, pushing price up, pushing price down, eventually it settles where it is. Okay, so that means that again, indecisive. Right, there are people buying, there are people selling, but at the end of the day, it just came back to where it is. Right, so again, understand this 4 foundation: open, close, high, low. It gives you a better understanding and the story behind how this candle is formed. Right, so when you see something like this, indecisiveness. Okay, so that's the first candle pattern you probably want to be familiar with. Now, then you have this second type of candle. We call it marubuzu. Again, the name, it's a conventional way of naming it. To me, as a trader, I think the naming you need to at least understand what it is, but it's not really the most important thing. Okay, you can obviously give it your own name, but for convention purposes, right? This type of candles where you see huge body, they are what we call marabuzu. Okay, now how this is formed, again, the story behind this candle, right? So if it's a white candle, it means that it opens lower, it closes higher. How does this candle form? It starts here. It didn't really travel a lot to the downside, and then it just went up all the way during that period of time, and it closes and settles at a high price. Okay, this tells you a story. It means that during this window period, a lot of traders are coming in and pushing the price higher. Now, in order for a push price higher, essentially means that people are buying. Okay, so I see a quick question over here from Amelia. There's no shadow. No, I mean, sometimes there's a little bit, it's fine. Okay, but essentially, Marbozo means that there are huge body relative to very, very tiny shadow. Okay, very, very seldom you see like zero shadow, in the currency world, you would see some bit of here and there, right? But the idea of this is that the body is like significantly bigger compared to whatever shadow that it may have. Okay, but of course, sometimes you will see perfect candle where, there's really no shadow at all. Okay, so the story behind it is that when you see a candle like this, okay, the conviction from the traders are pretty clear. If it's a bull one, right, it's a white color body, meaning prices went up. It means that a lot of buyers are coming in, and generally they are very convicted in that direction. They are basically pushing prices higher. Okay, the opposite is true. If today we have a black one, and it means that the price is actually closing at a lower price point, right? So it means during the period of time, there's a lot of sellers, and essentially they're just pushing prices lower. Right? So this means that the decision that traders make are very, very decisive. All right. So there's some hint whenever you see this pattern, okay, or see this candle. The first thing here is today, if a white one forms at the end of an uptrend, meaning, okay, if the market is going up, going up, going up, and you see a huge momentum candle here, this means that the buyers are still in control and they're all pushing prices, they're all buying, right? Which means that there's a very good probability the price will continue in its uptrend. Now, if today you see a downtrend, the prices has been coming down, coming down, coming down, and then at one point in time, you see a huge white candle. Okay, this tells you what? It means that initially the people, the traders are selling the market, right? They're pushing prices down. And then at one particular period of time, they just decide to stop selling and all the buyers are coming in to push prices up. Okay, so that means a reversal is likely to happen. Okay, so instead of again memorizing what it means and things like that, I really want you to understand the story behind how these candles are formed. And once you are able to understand that, you are able to decipher every candlestick that you can see on a chart. Okay, so I'm giving you examples on this, on how to read and understand the story behind. Okay, now if today you see a black one, right, it's basically the inverse of it, the opposite direction, right? If today the candle, the market is coming down and then you see a black, huge body, right, it means that sellers are in control, likelihood of a continuation very high. If today you see an uptrend, right, general prices are going up and then suddenly you see a huge black candle, it means that the buyers are losing control, sellers are coming in, pushing prices down, and there is a likelihood of a reversal. Okay, so every candle has a story. Every candle tells you a little bit of an information what the prices are doing within the market itself. Okay, so this is the second candlestick. Now, there's a third formation, right, which is the opposite of a marbozo. You don't have a huge body. You have a tiny body, but you have a very long wick, okay, or what we call shadow. Okay, so it looks something like that, right? You can see very small candle body, very small candle body, very small candle body, okay? And you have like long shadows, okay? So again, decipher the story behind how these candles are formed. Now, if you see something like that, what it means is that the market opened here, it traveled up, traveled down, and then eventually settles where it is. Pretty similar to the spinning tops, right? So this is kind of like telling you indecisiveness. Okay, the market started at one price, it traveled up, it traveled down, eventually it came back to where it started. A lot of buyers, a lot of sellers coming in, but they can't decide which direction. There's no one in control. Indecisiveness. Now, this dragonfly doji, okay, again, don't need to remember the name, understand what it means, understand the story behind it. You can see this here, started here, it went down initially, but at the end of the day, it closes at the top, right? What does it mean? It means that at one point in time, there's a lot of sellers trying to push price down, but within that period, they fail to maintain at the lower prices, and the buyers comes back in and successfully push all the prices back up. Okay, so think of it as initially people are selling, but at some point in time, there's a massive buying coming in to push prices all the way back to where it started. So this is kind of like a reversal, right? Or what we call a rejection. Okay, so when you see candlesticks formation like that, okay, when you see candlesticks formation like that, it often means a reversal as well. Okay, the opposite is this. Okay, so imagine today, right? The market is coming down, and then you see a rejection of a dragonfly doji, right? So it means that at some point in time, while the market is coming down, there's massive buyers coming in to push price back up. So it's a sign, again, the story behind it's a sign that buyers are getting in, buyers are taking control, and it's a potential reversal. Right? The opposite can be said for this. Okay, so some names that traders give, of course, you have like dragonfly doji, gravestone doji, but a more common name that traders give this kind of candlestick, we call it a pin bar. Okay, I mean, some of the traders here who are maybe a little bit more experienced would have heard of this name before. Okay, we call it pin bar. It's actually a reversal candlestick. Okay, pretty straightforward. Good. Right, so up to now, we have three types of candlestick spinning top, right? We have the Morbozo, which is a huge candle body, and then we have the Doji, which is very small candle body, and then long wicks, right? Depending on how the formation is. Some of this Doji means indecisiveness. Some of this Doji means potential reversal. Okay, now let me quickly jump into some of the chart examples here to show you, some of the live examples of candlesticks, right? You don't really need to worry about like what instrument this is or what time frame for now. I just want you to be able to look at those candles, okay, and kind of like understand the story behind it. Okay, so let's start off with the one on the right first, right? Okay, so you can see over here. Let me point it out for you. This candle. I mean, this one is still forming, it's still moving, right? So let's leave that aside. Let's focus on this huge one, right? So what you can see is that we have a very huge body and it's green. Okay, what does it mean? It means that the market started here, it went down a little bit, it went all the way up, and then it settled somewhere near the top. So it's a bullish candle, prices went up. And you realize that the candle body is huge. It's strong, right? There's a lot of momentum. It means that what? The buyers are in control. Okay. Look at this candle here. Okay, this is a very good example of what we mean by a doji, and it's indecisive, right? You can see the market opened here, it went down, it went up, it came back, eventually settling where it started. That's a doji. Okay. There are many forms of doji as well. This is a doji, this is a doji, right? So the thing here, or the tip for traders, is at the end of the day, you don't want to read and make a trading decision on every single candlestick. For now, it's just understanding the story behind. As we progress in today's session, I'll share with you a little bit more in terms of like how do you analyze the overall picture and then utilize candlestick to give you that extra layer of confirmation. Okay. So as a trader, you don't want to see like, oh, it's a huge green candle, let's buy. Okay, you don't do that, right? Later on, I'll share with you a little bit how you approach the market, but for now, just understand the story behind. Okay, look at this here. This is what we meant by a pin bar. Okay, you have the price here, it went down, and then the market rejected all the way back up, and then it closes near the top. Okay, so that's an example of a pin bar, example of a doji, indecisiveness, example of a Morobozo, right? Or what we call a strong candle body, right? So you can see here as well. Okay, so every candle gives you a understanding of what is happening during that particular window of period. Okay, so this one here, if I'm looking at a 30-minute, meaning every candlestick is a 30-minute window of period. Okay, if I look at a daily chart, then every candle here is 24 hours. Okay, meaning if today I'm looking at a daily chart, okay, the latest candle here, it's still developing, right? Meaning prices are still moving up and down. This would still continue to develop until the end of the day, then it will close, right? In the FX world, typically in Malaysia, the closing day or the closing time is at 5 a.m. Okay, and of course, there's some daylight saving adjustment you need to be aware of as well. Okay, so that's the understanding of individual candlesticks. Okay, so I hope that helps. Now, of course, today, if you understand one single candle, we start to be able to develop a bigger story when we look at patterns, right? Where we have like two candle formation together or more. Okay, so that's where I try to introduce to you guys a little bit more on like patterns, right? Instead of just one candle, we start to look at more candlesticks put together. It tells you a more holistic kind of a story behind it. Okay, so we have like engulfing patterns, right? We have the bullish and the bearish engulfing. The engulfing pattern essentially is where we have one candle, the body itself engulf the previous candle. Okay, so this one is a little bit clearer. You can see the black candle body, okay, kind of like eats up the entire white candle previously, right? So we call it engulfing. Okay, this one here, you can see the white one. Okay, same thing, right? The body here is significantly bigger than the previous candle body. So that's an engulfing. Usually the story behind engulfing is that it is a reversal sign when you put it into context, right? The market is coming down, and then we have like a bullish engulfing, right? A momentum of buyers coming in, and therefore it's a sign of a potential reversal. The opposite is true. Okay, so that's the engulfing, right? So again, if you go back to the charts over here, I think, Azizan here also say, right, is that a bullish engulfing, right? So this is a prime example of a bullish engulfing pattern, right? Let me just bring out the annotation as well. Right, you can see this, right? The market is coming down, coming down, coming down. We have this red candle, and then next candle here is a huge green candle. And when you put these two candlesticks together, that's an engulfing. Can you see that? Another example is here. Okay, a red and a green huge one that engulfs the other, right? So that's also an engulfing pattern. Okay, this one here, that's an engulfing pattern. Cool, right? So when you put two candlesticks together, it tells you a little bit more of a holistic story. Okay, then next here we have the tweezer bottoms. Okay, so tweezer bottoms, it's kind of like similar idea of a reversal, but basically it's made up of two candlesticks with shadows. Okay, so it's like two pin bars, one after another, right? So the opposite is true. So these are reversal signs. Okay, let me show you that. Okay, let's see if we can find some examples on the live market environment. Okay, they may not come like picture perfect all the time, Sometimes it's not as easy to identify them. Okay. So far we don't have any. We have a lot of engulfing in this examples, right? But we don't really have a lot of like that kind of pattern, right? Maybe one here you can identify is this one. Okay, not the most, kind of like picture perfect example. But what you see over here is that, again, you have two shadow, right? So what this means is the market try to push down, it fails, tries to push down again, it fails, and then eventually it takes off. Okay, so the story behind that candlestick is important. Oh, right. Yeah, here, this is not a good example, right? Again, it may not be the best, kind of like textbook example, but you can see the story behind it. The price came down, buyers push it up. Price came down, buyers push it up. Okay, so you kind of form two pin bar very close to one another. Go, yeah. So those are the tweezers, right? Tops and bottoms. Okay. Now, with all this understanding, right? Just like I mentioned, you don't want to just trade off the candle itself. Okay, you want to have extra layer of analysis, and that's where your support and resistance comes in. Okay. So in terms of support and resistance, it's basically an area in which prices tends to react. Okay, and you then focus on these areas and look for the candlestick formation that we cover so far within these areas. Okay. So support, as the name suggests, is basically an area which price tends to be bouncing up, and then resistance is basically an area in which price tends to be pushing down. Okay, and then you add in the candlestick as a confirmation. Cool. Good. So with that said, let me share with you a very, very simple example of support resistance on the chart. Okay. So if you look at this example over here, let me bring it across. Okay. Now, when you look at a chart, okay, overall it tends to have upside and downside movement, right? So if you take a look from this high here, the market came down, it bounced up a little bit, it comes down, it bounces out a little bit, it comes down, and then it continues, right? And then as it goes up, it's the same thing. It went up, it came down, it went up, it stalls a little bit, it will continue to go up, it pulls back. Okay, it tends to move in waves, ups and downs. Okay, and every time we have some areas where the market actually bounce and stall, okay, that forms your resistance and support area. Okay, let me use another tool to draw. I think that's a little bit more, it'll be clearer, right? So you can see over here, this forms an area of support resistance. Okay, as it comes up, this forms an area here as well. Okay, as it comes down here, this forms an area as well. Okay, so this forms an area here as well. It's not a specific price point, but in general, those are areas that you want to keep an eye on. Okay, so oftentimes the market will come back and react around it. Okay, so for example, I'll give you one here. If today the market is going up in general, we want to look out for areas of support to potentially buy it, right? Because we're going to follow the overarching trend. So when the market eventually pulls back towards an area over here, that's where we want to focus on the formation of the candle. Okay, or the opposite is true. Today we have this resistance where the market previously rejected to the downside. When it comes back towards the zone, you want to focus on potential candlestick that can form around the zone to maybe look for the sell trade. Okay, so that's the idea. That's the idea behind candlestick formation, right? You don't want to just buy or sell or make a decision just because of a single candle, but you want to use those story behind those candlesticks to add on the layers of support and resistance. Okay, so you first identify the key areas to be focusing on, and then when the price goes into these areas that you have identified, you look for those candle formation as a layer of confirmation. Right, so that's how we apply the principle. Okay, so if again you go back to the slide over here, right, once you have understood how the candle forms, the patterns of a candlestick, okay, align it with a simple support resistance. We also can add in a chart pattern into the analysis, right? So chart pattern is like even bigger patterns, right? We have like small individual candle, 2 candles pattern, and then we have like chart patterns we made up from multiple candlesticks together, right? Now, there are a couple of patterns you want to be familiar with. First one here is double top, double bottom. The second is head and shoulder. Okay, and the last one here is a wedge, right? I just call this a crawl pattern. Just give it another name. I think it's easier to understand. Okay. You don't need to trade all of them. You don't need to be like very familiar with all of them. At least know them. But at the end of the day, you don't trade all patterns, right? You just want to figure out which one kind of like you prefer, which is your favorite pattern, and just stick to that. Okay. So let's start off with understanding and show you guys a little bit of how this pattern looks like. Okay, first we have a double top, right? I think the name here suggests quite straightforward, right? We have the market coming up, forming one top, coming back down, going back up again, didn't manage to really break out of that, forms another top, and then starts to reverse, right? So this is kind of a reversal pattern, okay? So how it looks like eventually, this is how the pattern tends to develop, right? So you can see when it forms 2 tops, the market wasn't able to break through. Okay, the middle point of this 2 top is basically your neckline. Okay, and oftentimes the projection here is if the market were to break below the neckline, it's gonna make an equal distance of the neckline. Generally speaking, right? Okay, so that's a double top. Okay, now if you flip it, inverse it, that's a double bottom, right? Same principle. You have the middle point, your neckline. If it breaks, it tends to make equal leg of it. Okay, so very, very quickly, let me see if we can find some examples of a double bottom or a double top for you. Okay, let's see at the top over here if you can find any double top example. Okay, may not be the cleanest double top. Okay, but this is one good example. Okay, so we have one top, second top, a very nice little room, right? In between these 2 top, that's your neckline. Okay, when the market breaks through that neckline, we can often measure an equal distance, and then that is where the market tends to head towards. Okay, now obviously you don't want to just trade off, every double top. Okay, you want to wait for the confirmation, right? So as the market gives you a second top, that's where you start to look for candlestick formation. Okay, so you start to see here, right? We have a strong green candle followed by a red candle. That's a rejection sign. And then over here, we have also an engulfing pattern confirmation, right? So it start to stack that up. Okay, so hopefully you can see the application of things, right? So that's double top, double bottom. Okay. Then next, we also have the head and shoulder pattern. Okay. So head and shoulder pattern is a little bit more complex. This is a pattern that I personally don't really trade. But it looks like, a head and then 2 shoulder, right? So you kind of like left shoulder, right shoulder, and then you have the neckline that connects the bottom. It's a reversal pattern, right? It means that the market try to push higher, but fails eventually, and likelihood is coming down. Right? So how it looks like is this, same measurement. When it breaks the neckline, we expect an equal movement. Okay, if you mirror it, it's called inverse head and shoulder. I just call it head and shoulder as well. Same thing, left, right, A, right? Then you have the neckline. If it breaks it, it tends to make 1:1 movement. Cool. Let's see if I can find you an example of a head and shoulder pattern. Okay, so again, not all the time you're gonna find picture perfect examples. Let me just find one that's obvious for you. I think this is pretty good. Right, the market was initially coming up. It forms this top, comes down, goes back up, forms another top, comes down, it fails to form a higher high. That's your head and shoulder pattern. Can see that, right? Head and shoulder. So when this breaks the neckline, okay, what you can do is you can measure an equal leg, an equal movement. Oftentimes, that's the target for where you can expect price to go. Okay. Now, bear in mind, it doesn't mean that every time is going to work out perfectly. Okay. I just want you to see, this is a classic example of the patterns. Okay. As I mentioned, I don't really trade the head and shoulder pattern. Cool. Now, the last pattern here is a wedge, right? I call this a crawl. Okay. Why is it a crawl? The idea here is the market is going up, but then as it continues to hit higher, it's going slower and slower. The candle starts to be smaller and smaller and smaller. It's oftentimes a reversal pattern. Okay. Why? Because smaller candle body means not many activity, means the buyers are getting weaker, right? Again, understand those stories. Okay. And when the buyers are weak, likelihood of a reversal is there. I understand, right? So that's again potential reversal sign. Okay. Now you can measure that equal leg here as well, right? And if you flip it, it's essentially the same. Okay. So understand those stories behind those patterns, right? Let me just show you an example of it. Okay. Let's use this example here. Okay. Look at this. Use this tool. Look at this here. Okay, as the market comes down, it starts to slow down. The candles are smaller, that is less sellers, it push up. Then it comes down again, smaller, push up. Can see that, right? Okay, so those are crawl patterns. Okay, I personally love to trade the crawl patterns. Okay, if you take a look at some other pairs like, Aussie dollar. Okay, example of the crawl patterns, you can see here, right? Coming down, smaller candle bodies, reversal sign. Okay. This one here is a good example as well. Going up, smaller bodies, reversal sign. Cool. Yeah, so those are candle formations, right? Chart patterns, candlesticks, right? And then what you want to do, you always layer with support and resistance to help you make decisions on your trading, right? So for example, right here, okay, this is previous areas that price bounced. The market is coming back and retesting it. What can we look out for? Okay, the first pattern here we can look out for is potentially a double bottom formation, right? But for double bottom to form, we have a neckline. We have a neckline. Price needs to break that neckline. Then only we can start to be confirming the upside, right? We need to break that neckline to form that double bottom. Okay. And then what we can also look out is if you want to go in earlier, if let's say we have a bullish engulfing candle here, that's an early sign, or if we have a pin around this area as a double bottom formation, if a pin bar forms, that's also a candlestick formation, right? So you want to stack those things up to increase your odds of analysis and your odds of winning. Hopefully that kind of makes sense. So far so good. Cool. Right. So hopefully, today's session as of now, we'll have some Q&A as we progress. But hopefully up to this point in time, you guys can follow through, right? From understanding how price are formed, understanding the story behind a single candle, and how that progressively built into chart patterns to give you that understanding of what's happening within prices, right? The story behind it and how you can actually use that information to assist you in your trading. Okay. So I do see a couple of questions coming in. So let me kind of address some of those questions over here. Okay. So the first one, I think I'll just I will not answer them in sequence. I'll just answer those. I think it's more straightforward first, and then we'll dive into a little bit more of like I would say more advanced question. Okay. So Firdaus over here asks, what time frame do I usually refer to? For me personally, I look at the 4-hour most of the time. Okay, so hopefully that helps. But of course, it doesn't mean that that's the best time frame, right? But generally for me, I like to look at a 4-hour time frame. Okay. Mooney here says lower time frame can look for tweezer pattern. Yeah. Okay. So what you can also play around with is, you can have like 4-hour time frame, and then you can go down to like maybe 30-minute to look for confirmation of candlestick formation. You can always do something like that. Play around with multiple time frames. Okay. But the idea is you don't want to have like too many, right? Some traders will have like 4 or 5 different time frames, and then it confuses them. You want to avoid that, right? So my suggestion is maybe at least maybe 1 or 2, but never exit 3, right? Never go more than 3 time frames. Okay. We know it's engulfing, but is there any way to anticipate how long this upward or downtrend may continue? Very good question. So usually we look at support and resistance again, right? So if I just use example like this, okay, we have areas of resistance here, areas of support here, right? So the idea is today, if you're buying, right, if you're expecting price to go higher, you're buying it. Your primary target will be where the next key area of resistance is going to be, right? So that's your primary take profit or primary target. That's your first area. Now, can the market continue to move higher? Absolutely, right? So then what you do, you look for the next area of resistance, where the price would likely tend to react, okay? So basic understanding of support and resistance are very, very crucial in knowing where would price likely react off, right? And those are the areas you want to be focusing a little bit more. Okay. Sally here asks, are there any guidelines you follow when pattern develop overlap Fibonacci retracement or extension? Yes, as well. Okay, so for more advanced traders, you can actually add on layers of Fibonacci. Okay, let me see if we can pick one example over here. Now let's just say this example, right? We have a little bit of a double bottom structure here that has developed, right? Okay, and then of course price broke that neckline, so kind of confirmation of an upside. What we can do is we can take in Fibonacci, swing high to swing low. Okay, let's just keep things simple for now. Let's say we focus on the 618. What happens over here is you can actually wait for price to come down to 618. Okay, and then that's your key area, right? So think of it as like support. Okay, and then if you want confluence that with some sort of a candlestick formation, maybe if here you see a rejection pin bar, that can be an indication for you to take the trade up. Okay, or it can be an engulfing bar developing here, or it can be a lower time frame mini double bottom, right? So that's where you can see how these principles and concepts are being put in place. Cool. Where's the best way to put stop loss? If you enter a neckline, typically you're gonna have your stop loss at, let's say this is a double bottom, it's a neckline, right? So you're gonna put your stop loss at the bottom, and then you target minimally 1:1. Okay, usually that's how it's being done. Okay, same thing for head and shoulder. Okay, same thing for head and shoulder. Let's just say we have anything obvious. Okay, that's not the best. Okay, let's just say we use this example, right? We have this as a head and shoulder, right? And of course, our neckline would then be here. Okay, so today, if you trade the breakout of it, okay, your stop loss would have to go above that high, and then you target 1:1, right? So in this case, this worked out perfectly. Of course, you can always customize your stop loss to make it slightly lower, depending on your personal experience as well, right? But the simplest way to do it is just put your stop above that. Okay. So usually, if you look at traditional and conventional way of trading all these patterns, you enter at the break of the neckline, and then your stop loss is at the previous swing highs and lows. Okay. Any time frame can use for confirmation to find setup. My suggestion is, have 2 time frames. So like if I'm using 4-hour, what I often can do is I go down to the hourly time frame and look for the candlestick confirmation. Okay. You can also still stick to the same time frame, like 4-hour time frame to analyze, and then I'll just wait for a 4-hour candle to form as a confirmation to enter a trade, possible as well. Okay, so there's really no like rule to that. It's an individual preference, but you can always play around different time frames to give you more information of the story behind price development and the candlestick. Okay. Fatihar here asks, candlestick versus line chart. Is that line chart can help to reduce any false breakout? Potentially, right? So sometimes I tell traders, if today the candles charts are a little bit more complex to you, you can actually change it to a line chart and things looks a little bit cleaner. But to be very honest, it doesn't really make much difference to, I would say, more experienced traders. So eventually you want to practice and train your eyes to be familiarized with candlesticks. Okay, the difference between a candlestick and a line chart is usually a line chart only plots the closing price. Okay, but candlestick gives you 4 data points: open, close, high, low. A line chart only gives you a closing price data point. Okay, so that's the difference. So there are less noise in a way because there's only one data point. But sometimes, line chart doesn't give you the details that you need from a candlestick. Okay, so give and take depending on which one fits you. Okay, last question I see, among the candlestick patterns, which is the easiest to identify and trade? To me, it's a crawl. It's the wedge. And a pin bar, right? I think if you ask me to pick a chart pattern, it's going to be a wedge. If you ask me to pick a candlestick pattern, it's going to be the pin bar. I think these are the easiest one to me, but different people have different viewpoints, right? Some traders prefer head and shoulders. Some of them are easier to look out for double top, double bottom. Different traders would have slightly different, ease of identifying those patterns. But for me personally, would be the pin bar as well as the wedge, right? Or I call it the crawl pattern. Cool. Good. So I hope up to this point, everyone is clear. Any other questions that you guys have? All good. If that, then I'll pass the time back to the moderator for today to kind of wrap up the session for us as well.
All right, great. So that concludes our webinar today. And once again, thank you, Kar Yong, for the great sharing and also spending your evening with us. And of course, thank you to all of you for being here with us on this special Friday. So once again, we're glad to see you here and we're glad to be on your journey. And thank you so much. Have a great day, all of you.